Hello, welcome back to International Finance. So this week we're going to discuss international capital structure and the cost of capital. In our last lectures, we looked at option strategies. We discussed various option strategies depending on your expectations and your hedging needs. We also have looked at foreign direct investment and tried to understand it through the lens of real options. We said FDI involves taking a controlling stake, 10% or more generally. You can have a greenfield investment where you build a brand new facility, or you can have a merger and acquisition where you buy an established firm. And typically you'll do this for access to suppliers, market share, corporate strategy, synergies, etc. These are very long-term investments that bring significant financial frictions because of the uncertainty, the political risk, the irreversibility, the fact that these investments are lumpy, so you can't really undo an investment decision midway through. And we said the way that we can identify financial flexibility and value it is with real options, the option to delay, expand, abandon, very similar to calls and puts. This lecture is all about international capital structure and the cost of capital. So let's kind of revisit our friend, the present value equation. On the left-hand side, we've got firm value, and on the right-hand side, we've got the sum of free cash flows, infinite sum, discounted each by the WACC, the weighted average cost of capital, for the various time periods. What we're going to do in this lecture is focus extensively on that denominator, that WACC, our discount rate. And what you can automatically see, hopefully, is that because that WACC, our discount rate, is in the denominator, if we can get it smaller, if we can get a smaller discount rate, a smaller cost of capital, we're going to increase firm value. Shrink the denominator, the whole fraction gets bigger. So let's jump right in. In all of our previous lectures, the cost of capital, the discount rate, was given to us. In this lecture, we're going to focus on understanding the cost of capital. That is, the discount rate to apply to future cash flows that reflects the riskiness of those cash flows. So recall from the CAPM equation, what do we have? We have, sorry, one moment, a little frozen on me. Okay, recall from our CAPM equation in the intro finance course. On your left-hand side, you've got the expected return. On the right-hand side, you've got the risk-free rate plus beta multiplied by the market risk premium. The expected return for firm I is what we use to discount the cash flows for firm I. For example, if the expected return for firm I was 12%, then investing 1 million in firm I for 1 year would yield 1.12 million, 1.12 million in expectation. Therefore, if firm I provided you with an expected payment of 1.12 million next year, today it would be worth 1 million. You would discount it using that discount rate, the expected return on firm I. That expected return can be decomposed into two components. There's the risk-free rate, and then there's the risk premium for firm I, which is going to be the additional compensation that you get for bearing market risk. That risk premium for firm I is its beta multiplied by the market risk premium. And what's the main idea? Again, a refresher from the CAPM. We know that under the CAPM, investors do not require compensation for firm-specific risk because they're well diversified across many projects, many assets. Investors cannot diversify away from systematic risk, market risk. Therefore, they require compensation for systematic risk in the form of a higher expected return. So this is our CAPM idea, right? We've got a very well diversified portfolio because we hold so many assets across so many projects, everything in every dimension. We worry less and less and less about firm-specific risk. We worry much more about the systematic risk, the risk that we can't diversify away. How do we measure systematic risk? Well, you use the asset beta of the firm. Recall that your assets are equal to your liabilities, your debt, plus your equity. The beta of your assets is equal to the weighted sum of the beta of your liabilities plus the beta of your equity. So on our left-hand side, we've got the beta of our assets. And on the right-hand side, we're taking a weighted value using our debt to equity mix and then taking the fraction of debt and debt to equity or equity and debt to equity, and then using that to create basically the weighted sum of the firm's risk. So we've got the risk from our debt, our beta debt, and then we also have the risk from our equity, the beta of our equity. The pre-tax weighted average cost of capital, the WACC, it's very similar to the weighted beta from the equation on the previous slide. On our left-hand side, we've got the discount rate on assets, and on the right-hand side, what do we have? Well, the exact same idea. We take the weighted sum. So we're using the capital structure, the ratio of debt to total debt and equity, and the ratio of equity to total debt and equity, and multiplying both of those by the required return on debt, basically how costly is it, what's the cost of my debt, and then also the cost of equity, how costly is the equity for the firm. When we consider corporate taxes, we have our weighted after-tax WACC, which is very similar to our WACC. Again, we're going to take the mix of debt and equity, and now because we also know that there is the tax benefit to debt, it's going to be the weighted value of the debt multiplied by the return on debt multiplied by 1 minus the corporate tax rate. So this is all a refresher from stuff that I'm sure you've seen in your other finance courses as you've gone through the WACC and the weighted average cost of capital, the after-tax weighted average cost of capital. Let's kind of unpack that cost of capital a bit. So recall the NPV equation, a friend. On our left-hand side, we've got NPV. On our right-hand side, we've got our cash flow zero. So typically, this will be a negative number, the cost of investing in the project. And then we've got the present value of our expected cash flows discounted appropriately through all these different time periods. Our rule has been, if we find that the NPV is greater than zero, we invest in the project. Positive NPV, we go ahead for it. So if we lower the discount rate, RA, we increase firm value by increasing the NPV of the current investment projects. Think about it. If the denominator in all of these series becomes smaller, well, then the present value of those expected cash flows increases. So we increase the NPV. Also, the firm may invest more as projects that had a non-positive NPV may now have a positive NPV due to the reduced discount rate. Let's look at that through a graph to kind of unpack it a bit. So what do we have? Okay, on our vertical axis, we have the cost of capital, the discount rate that the firm is using for its investments, its projects, etc. On our horizontal axis, on the x-axis, we've got the investment schedule for the firm. And what's the big takeaway? Well, the graph shows that as we lower the cost of capital, as we go from paying what we would pay to have capital if it was only priced locally to the cost of capital if it were priced globally, we can see that there's this large increase in investment. And what's the key idea? If we lower the discount rate, we raise firm value because now the present value of all of these expected cash flows is higher, and we potentially increase investments. So how can we lower the discount rate? Our answer will be to go from local to global capital markets. How will we find this discount rate? We will apply the CAPM to calculate the firm's discount rate. For our class, we're going to assume the marginal investor is risk averse, so she likes returns, she does not like risk, and not a large or controlling shareholder. That is, the investor that trades the security wants higher returns, lower risk, and must take the expected return, the volatility, and the correlation of the firm as a given. Here I'm introducing you to notation that if you haven't seen before, you'll see over and over as you study portfolio choice or as you look at the investment decisions. We've got our expected return, on average, how much do we make? We've got our volatility, our standard deviation, and then we have rho. our correlation. And correlation, I'm sure you've seen before. Since the marginal investor does not control the company, the investor manages expected returns and risk with portfolio choice. That is, the investor won't increase expected returns by replacing bad managers. We're not going to reduce risk by pushing the firm to operate in an industry with less volatile cash flows or to operate in a country that has more stable exchange rates. A very different setting from what we discussed with FDI, because again, we're not assuming that the marginal investor has corporate control. If you're not familiar with this term marginal investor, what we're trying to identify is the investor who would buy or sell the share of the market that's trading. So whatever share of the firm is trading, that's what we're interested in. Okay, let's turn to our CAPM. So in order to estimate the expected return, we need three inputs. We need our risk-free rate, our market risk premium, and the beta of the firm. We will apply the CAPM locally, so we're going to use local market values, and then globally, and we'll see how very quickly we can encounter a different discount rate by going from local to global. The risk-free rate in the CAPM is the rate at which investors can both borrow and save risk-free. US Treasuries, government bonds are generally viewed as the safest investment. So we will use the yield on US Treasuries as the risk-free rate. So this is a question that comes up quite often. If we're having a course on international finance, why would we use the US Treasury as the risk-free rate? And the answer is that all around the world, asset managers are able to essentially invest and borrow and save at the US risk-free rate. So this is still globally considered a good measure of risk-free return. So what are we going to do? We'll match the maturity of the project to the yield curve. So if it's a 1-year project, we'll apply the annual yield on a 1-year risk-free rate. If it's a 10-year project, we'll apply the annual yield on the 10-year risk-free rate. In practice, oftentimes, because when we want to price equities, we think of equities as perpetual because we can take the dividend stream or the potential dividend stream and use that to price the equity. So oftentimes in real life, individuals will use the expected return or the monthly return on a 1-year or 30-year treasury. It all kind of depends on the horizon that we're looking at. The yield curve, if you're not familiar with the yield curve, what do we have? On our vertical axis, we have the yield to maturity for US government bonds. On our horizontal axis, we have different maturities for these US government bonds. The yield curve shows the promised rate of return for government bonds across these different maturities. What you notice is that investors demand a higher yield for longer maturities. The yield is the required return that I'm going to earn if I'm an investor and I'm holding this bond. Why do you think an investor would demand a higher yield for a longer maturity? Well, obviously, because there's inflation risk. So if I'm holding a bond for 1 month versus holding a bond for 30 years, I'm much more concerned about inflation over the course of 30 years. I'm also much more concerned about interest rate risk over the course of 30 years versus over the course of a month. So you'll observe this too when we get into the betas of debt, that if we have a longer maturity, we're much more worried because obviously these promised cash flows are going to be much more susceptible to our interest rates, our inflations, and kind of movements and expectations in economic activity. Okay, so we've got part 1 down, our risk-free rate. We're going to use US government bonds, and depending upon the life of our project, we'll try to match the maturity of the project. The next piece of our CAPM is the market risk premium. Our risk-free rate, our returns from the market minus our risk-free rate. So let's jump in. Choosing the market risk premium. The market risk premium is the expected return of the market portfolio in excess of the risk-free rate. The market portfolio is a evaluated portfolio of all securities that trade in the market. So anything That should include human capital, real estate. That should be internationally and domestically well diversified. It should include patents. It should include IP. It should include any asset that has any value whatsoever. But in practice, we typically use a proxy for the market. So for the world market portfolio, oftentimes asset managers will use the MSCI Global Index or an S&P 500 Global Index or something comparable. For individual markets like the US, you'll use the S&P 500 to proxy for it. For Argentina, you'll use the Merval. For South Korea, you'll use the KOSPI. For Germany, you'll use the DAX and so forth. So already, hopefully you can see there's a little bit of tension. In theory, our market portfolio is supposed to be everything, which would include international domestic assets, real estate assets, everything. But in reality, when we try to test our CAPM and apply the CAPM, we're using market portfolios that identify all of these different markets. So we have a world market portfolio, a market portfolio for the US, for many different countries. Canada, pick a country. If it has publicly listed securities, it has its own market portfolio. Why is that important? That's important because hopefully you're starting to get a sense that there's some tension between how we can raise capital globally versus how we can raise capital locally because of this market segmentation. So let's get deeper into our market risk premium. We need to calculate the expectation of the market going forward. That is incredibly difficult. It is very difficult to know what you expect the market price of risk to be in the future. Because it's so hard to know what the market expects going forward, instead, we're going to use past data to estimate expected market risk premium. How are we going to do that? We're going to use averages. So we can look through history and find the average return, the average excess return for the market, for a world market portfolio, for the US market, pick a country. What are we going to do with those averages? Well, the historical average is going to provide a really great proxy for the expected market risk premium. There are two pieces of language that I want to introduce to you if you're not familiar with them, that again are bread and butter when we're talking about portfolio choice and how we expect markets to perform. Those terms are excess returns. So we have the excess return for the market, which is also the market risk premium. I know it's a lot of terminology, but this is the language that we use when we discuss this type of investment activity. We have the excess return for the market, so that's the return for the market minus the risk-free rate. And we also have the excess return for the security. That's the return for any security minus the risk-free rate. So we use the average return, the average excess return for the market as our proxy for the expected return on the market risk premium. Okay, so we've got our risk-free rate. We know that we can use US government bonds, we can maturity match, we can look along the yield curve, find the same maturity of our project. Awesome. We also have our market risk premium. We know that there are many different markets. So there's the world market, there are country-specific market indices. Okay, fine. But the way that we're going to identify our market risk premium is with averages. So we have the return for the market minus the risk-free rate. We can look across a long time series, so 20 years, 10 years, 30 years, and we'll use that to get an average return, the average expected market risk premium, or the average excess return for the market. The last thing that we need for our CAPM is the beta. How are we going to calculate the beta? Well, beta is really a regression coefficient, meaning it's the covariance of the security with the market divided by the variance of the market. Beta is usually going to be calculated by running a linear regression of historical returns versus market returns. What does that mean? Typically, when you're estimating beta on your left-hand side, so when you estimate the equation, and this is what you'll do in your next problem set, you'll cover this. When you estimate beta on your left-hand side, you've got the return for the asset minus the risk-free rate. And what you're estimating will have a constant, and then the return for the market minus the risk-free rate. The estimated coefficient, the thing that you're trying to pin down with your regression, is the beta. And what is that? Again, it's the covariance of the asset with the market divided by the variance of the market. If you're not super familiar with covariance, you can think of it as really measuring how things kind of co-move. Are two assets, or does the asset in the market, do they kind of deviate from their mean in the same time, or do they deviate from their mean in different directions? What does that mean? It means, are they going up together, or are they moving in different directions? It's really a good way for us to think about co-movement. Okay, so you have the returns for Cisco, the excess returns for Cisco on the left-hand side, and on the right-hand side, you've got the excess return for the S&P 500. In Excel, you estimate a linear regression, and this is what you get. The slope of this line is beta. It's, again, the covariance of Cisco divided by the variance of the market. So this is basically your best fit line. And what do you have with this regression? Well, there are two things I hope that you notice. First, notice how many of these dots do not sit perfectly along this red line. Yeah, that makes sense. Those dots that are being plotted, those are the returns for Cisco and the returns for the market on any given month. So in November of 2002, you can see that Cisco had a return of almost 34%, and the S&P had an excess return of almost 9%. So it's plotting in real time across all of these different time periods what's the excess return for the asset and the excess return for the market. Then through that plot, we estimate this best fit line. And what the second thing I hope you observe is the distance between each of these plots and that best fit line. That distance is the thing that's actually being minimized on average as you estimate this regression. If none of that means anything to you, hopefully this will. The distance between that dot and the best fit line, that is your diversifiable risk. That is your firm-specific risk. On average, in order to estimate this equation, you have to assume that the firm-specific risk cancels out, that on average, it's going to equal to 0. And again, this is pretty much the foundational idea behind our CAPM. So how do you find the asset beta of your firm? Well, recall that your assets equal to your liabilities plus your equity. So what do? Well, this is how we started the lecture. The beta of your asset is going to equal the weighted sum of the beta of your liabilities plus the beta of your equity. So I've got the total value of my debt divided by my debt plus equity. I multiply that by the beta of my debt. I've got the total value of my equity divided by my debt plus my equity. I multiply that by the beta of my equity. In doing so, I now have an asset beta that, again, it's value weighted. So I'm taking into account that the firm has capital structure, and that capital structure, when I say capital structure, I mean the firm has a level of debt and the firm has a level of equity. And each of those assets, each piece of the firm's capital structure that forms its total assets, together, we have the beta of the assets. How do you estimate the beta of equity? Well, with regressions. The beta of equity can be found by regressing the firm's historical excess stock returns on the historical excess market return. And that's what we just saw in the example of Cisco a few slides back. How do you estimate the beta of debt? Well, with regressions too. The beta of debt can be found in a very similar manner with regressions of historical market excess returns on excess returns for debt. If you do not have historical return information on your debt, Sometimes you can use 0 or something very, very low, like something less than 0.1 if your debt is low risk. You want to use a higher beta if your debt is high risk. And to see why, please take a look at the table. So what am I showing you? I'm showing you average betas across different debt levels, so different quality ratings categories for debt, and then also by different maturities. So anything A and above, anything really triple B and above, you can think of as investment grade debt. Notice that with really, really high rated debt, so debt that poses very low risk of being defaulted on, it has a very low beta. And hopefully that makes intuitive sense. We don't think of something safe as being risky. So if it's very safe debt, it should have a very low beta. Notice what happens when we get up to triple C. So when we get to triple C, that's below investment grade debt, very risky debt. Notice how the beta of the triple C debt is considerably higher than the beta of A and above. Same story when we look at maturity structure. So notice how the debt that has a short maturity structure, the debt that's due anywhere from 1 to 5 years, has a beta of 0.01, and the debt that has a long maturity structure, so 10 to 15 years and 15 years onward, we see betas of 0.07 all the way up to 0.14. So a considerable jump in risk. What's the big punchline and takeaway? Well, when we have safer assets, they should have a lower beta, and that should make intuitive sense. When we have riskier assets, they should have a higher beta because they're going to be co-moving a lot more with the market. Okay, wonderful. So we've got our CAPM. We know how to identify our risk-free rate. We said we're going to use the US yield curve, and we're going to match maturities with US government bonds. We know how to measure and estimate our market risk premium. We can take the excess return on our market, and our market could be a country-specific market or the world market portfolio. And using that excess return on the market, we're going to get a historical average, and that average will be our expectation. We also know how to estimate beta. We said beta is the covariance of the asset with the market divided by the variance of the market. So it's a regression coefficient. Our beta can be our asset beta, in which case it's going to be weighted by our capital structure. And then we also hopefully are very comfortable with the idea that higher beta means higher risk. Wonderful. So higher covariance with the market implies higher beta. A higher beta implies higher expected returns to compensate for higher exposure to systematic risk. Let's kind of unpack beta just a little bit more so we can better understand how firms can reduce the cost of capital through cross-listing and being globally diversified. Okay, so as we said, beta is a regression coefficient. In the numerator, we have covariance. Covariance is correlation multiplied by the volatility of the asset and the volatility of the market. So what does that mean? Correlation, we know our correlations are going to be bound between +1 and -1. And it's a very intuitive way of understanding how things move together. When assets are perfectly correlated, they move together in lockstep. When they're perfectly negatively correlated, they move in opposition. If this is kind of a tough thing to think about, let's use a really simple example. So a great example, you can think about rain and an umbrella. When it rains, you use an umbrella. When it's not raining, only on rare occasion will you pull out an umbrella. You would think that rain and umbrella usage are positively correlated. They're not perfectly correlated because there are times that you use an umbrella when it doesn't rain, but they're positively correlated. They're highly positively correlated because, as we said, when it rains, you pull out an umbrella. Why are we talking that way? We're talking that way because I really hope that we understand what that correlation is telling us. If this asset co-moves a lot with the market, it's very risky. Why? Because under the CAPM, the market portfolio is the best portfolio that I can hold. And the market portfolio is really reflecting all of the risks that I face as an investor. So if an asset co-moves a lot with the market portfolio, it's not offering me any protection against the market portfolio. And in exchange for the asset being so risky, I really want a higher risk premium. I really want to be compensated as an investor. In our denominator of beta, we've got our variance, and we know variance is our standard deviation squared. So when we put it all together, what do we learn? We can identify that if an asset has a higher correlation with the market, or if the asset is more volatile, all things held equal, we would expect the asset to have a higher beta, which implies higher compensation for higher exposure to systematic risk. So increase the correlation or increase the volatility. We have a higher beta, higher discount rate, because as an investor, you're putting a lot of risk in my hands. Suppose you observe the following asset returns, volatilities, and correlations. How can we apply the CAPM to find the appropriate discount rate for the firm? So we're just going to pause here, and in part 2 of the video, we're going to go through solving and applying the CAPM, and then we're going to discuss how it can break down because investors are less internationally diversified than we would expect.